We do have a ton of reports coming, and then we have the Fed meeting. Do you care more about the reports or the Fed? I have to go with Fed here.
I mean, this is what everybody's been waiting for, of course, Andrew. This is arguably, we should have had this meeting, it seems like yesterday, because that's what the markets have worried about. But I think both of these things are going to be really important. Look, if you look at the market setup right now, valuations of stocks across the board, like growth, tech, innovations, have corrected massively already. You've had this significant rotation out of growth stocks and into value. And you have oversold conditions on a lot of these tech shares, for example. But what's been missing for a bounce back has been more clarity on the Fed. Right now, the markets are very fearful of the Fed. They think it could be more hawkish than anybody expects. And so, yes, all eyes are going to be on Powell on Wednesday. And I think if all they do is say, we're maybe going to hike rates 4 times and we're going to start the balance sheet runoff in July, I think that's no more hawkish than feared, and the markets can stabilize a little bit here. But the other big factor is you've got Microsoft, you've got Apple, and what happened last week, but the downdraft was caused by a lot of bellwether earnings disappointments, and banks, by the way, didn't help that much. But if that narrative shifts this week, and you got 30% of the tech sector reporting, if they reaffirm revenues, and by the way, revenues for software names are projected to grow 22% in the next 12 months, and that number has been rising, I think a lot of investors will look at the Fed that's no more hawkish than feared, and software and tech earnings that are actually better than expected. That could be what the market really needs to regain some footing here.
Uma, would you touch the NASDAQ with everything going on right now?
What's really interesting, Andrew, is that in the last couple months, and I would say in about March of 2020, we saw in terms of that valuation spread between growth and value, we saw that really peak out. And at this point, that spread has come back to historical levels. And so at this point, really, there's not much of that risk that you're getting and much of that payback you're getting for investing in that value versus growth spread. And so at this point, the focus really should be on companies that have the sustainable earnings growth, especially in this inflationary environment that we think is going to persist throughout this year. That's where the focus really should be.
And what are you expecting from the Fed?
Similar to what you just heard, right? We're at this point, the market is looking at potentially 4 rate hikes coming this year. The question is really whether the Fed kind of overshoots this reaction to get inflation back under control. And that's really the risk, right? And I kind of equate this to going into a shower in a hotel and you're turning on that hot water knob and you don't know what that delay is going to be and you don't want to turn it off too hard that you're going to scald yourself. And that's really where I think that sweet spot is trying to walk that line for the Fed is going to be really important.